This property is a 300% return in 2 years. All right, thanks guys for tuning into this episode where I'm going to address some of your concerns about potentially investing in smaller communities, tertiary markets versus major A-class real estate. First off, I just want to lay it right out on the table. I live in Calgary. I own property in Calgary. I own property in British Columbia, property in Ontario. I own property all over the country. I've invested into single family. I've invested into fix and flips. I've invested into small multifamily as well as medium and large multifamily. Now, by far and away, the absolute best return on investment for cash flow, you're looking at larger multifamily. It's got the lowest risk and the highest reward. In my opinion, it's by far the best thing that you can buy that's going to generate you consistent returns. If you do it correctly, it's going to generate you the highest returns with the lowest amount of risk. When you actually renovate this property, increase the rents and stabilize it, you can refinance that property and pull out all your investment and then some within just a few years, usually about 2. One of the main reasons you're probably even watching this video is because I'm sure you've been looking at single family or smaller multifamily or maybe even larger multifamily properties in larger markets like Vancouver, Toronto, major established cities. But what you're going to start seeing is that for your standard, not high end, but just your standard apartment building or single family home, the rents don't cover the mortgage and costs. So you can't cash flow these properties. And that's what's happening. The value of homes is increasing so rapidly and the rents are not catching up that it's making this market not work. As an investor, the markets, from my perspective, just don't work. Unless you're okay with sustaining losses and waiting for appreciation in the refinance. I mean, that is the whole business model on its own, but that's not what we're talking about here today. What we're talking about here today is how to make you the most cash flow, the most return on your investment. So I'm going to give you guys a few different examples. The first one I just gave you guys was in a major city. Now let's go to, let's say, the interior British Columbia, like the Okanagan region. So Vancouver, you're 250,000 a door in multifamily properties. So when you get into the Okanagan region, you're at about 125 to 175,000 a door, depending on the area that you're buying in. Now again, those properties are kind of a break-even properties. They don't really generate very much cash flow. You know, you're talking a 30-year payback, a 25 to 30-year payback, depending on the rents that you can collect. And in my opinion, that's not a very good investment. So if you're just looking for low risk, put your money here, let it grow at 3% a year, sure, maybe that's the investment for you. But what I'm talking about here is something drastically different. What I go to and I find are tertiary markets. So a tertiary market is not a major center. So you got, let's call it A, B, and C class. A would be a major city. B would be, a mid-sized city, call it 50 to 75,000. And C, let's talk about, 25,000 and under. So those are the markets that I'm looking for and that I want to invest in. Now, the reason that you do that is because in those markets, you can find properties that you're going to be buying for, let's say, 60 to 20,000 a door. 20,000 a door versus 200,000 a door. Think about the returns when the rents are nearly the same. However, your actual property you've purchased at 30 cents on the dollar in comparison to a major city, right? So it all depends on the way that you look at it, but how I do the math in my head is simple. I look at price per door and I look at how long until I get paid back. So if we can start doing some real math, and I'll tell you guys on properties that I personally own, I'll tell you guys the exact math. So in one of the properties that I own in Greenstone, Ontario, in that small city, I bought the building for $1 million. I put 30% down. So I paid $300,000 plus closing costs, $330,000 for that property. The first 12 months I owned that property, it cash flowed me after paying all expenses and after paying taxes, everything. It cash flowed me $116,000. $116,000. So that is if you do the math on that, that's less than a 3-year payback on that property. However, it gets even better. Now I'm refinancing that property. So I took that property, when I bought it, it was at about 30% capacity in terms of the people living in it. I brought it up to about 95% now, give or take. We lose a tenant, gain a tenant here and there, but it's at right around 95%. And now I'm refinancing that property for $2.24 million. So just to let that stick, that's with CMHC. They're giving me a 1.99% interest rate for 35 years. So my payments are going to be almost the same on my mortgage. They go up by whatever, let's call it $800 a month. But now I get to pull out cash $1.1 million in 18 months. So not only in the first year did this property pay me back $116,000, so 30% of my initial investment, on top of that, I've just pulled out, in terms of an equity play, $1 million tax-free income. Tax-free, ladies and gentlemen. 1 million plus 116,000 in, let's say, 2 years. So this property is a 300% return in 2 years. Where else can you do that, ladies and gentlemen? Where can you do it? Because I've never heard of it anywhere else. So let's talk about the advantages and disadvantages of a big city, and then the advantages and disadvantages of a tertiary market. So in a major center, you have access to a large tenant pool. Absolutely. Secondly, you're going to have more stable rents. And third, you can easily go and touch and feel that building by jumping in a plane and flying back and forth if there's ever any major problems. So that's your pros. The cons are it's very hard, or in some cases impossible, to actually make a decent return on investment, or sometimes any return on investment at all. So the major advantages of being in a tertiary market are you can buy the properties at a lower value, and you can charge usually the same rents as you can in a major market. So the payback period on those properties are significantly better than they would be in a major market. Now the downfall is, yes, there is more risk in a smaller center. However, when you're dealing with somebody like me who knows the market extremely well, I have property managers on the ground. I've been doing this for nearly 5 years. I own hundreds of units of real estate. And this model is sound and proven. Your level of risk starts to diminish very, very quickly when I can show you the types of returns that I'm showing you in these markets. Now, what you need to understand when you're investing with me is that you're not investing in just these assets. You're investing into me personally. And based on the business model that I just explained to you guys, where we buy multifamily properties for 40 and 30 cents on the dollar, we then renovate them, increase the rents to the highest possible market rents. We stabilize the rents by filling these properties up, and then we go through the refinancing process where we can then pull out all of our initial investment and then some and pay you back all of your money with interest in typically 2 to 2.5 years. Now, when you look at the business model that way, you can see there's a lot less risk. I'm not asking you to give me your money for 30 years. I'm asking you to place your money with me for 2 to 3 years. And you're going to want to continue reinvesting that money with me, because as a business owner, don't forget, I also invest millions of dollars of my own money into these projects. And so I'm just as invested as you to make sure that these ventures are an absolute astounding success. So thank you guys very much for listening, and I really hope to hear from you guys soon.